Hello, everyone. Again, it's Christopher Calandra. People are still making their way into the presentation, but I do want to start on time. Just to set expectations, I figure this will last roughly 20 minutes. Should go pretty quick. So I want to welcome everyone to today's workshop. I'd like to share with you some of the tax law changes that President Biden proposed during his presidential campaign and what that could mean for you. There's a lot of information out there to digest. So our hope is to simplify it down to some of the key items that I think you would want to be aware of. Our goal as a financial planning firm is to help our clients achieve greater financial success, and part of that is to be tax efficient. So we need to be aware of potential tax law changes, and so this presentation is meant to accomplish that. Keep in mind that this is merely a non-political summary, and also keep in mind that this is intended for informational purposes only. It would be premature to go out and act on anything that we discussed in this workshop. So during his campaign, President Joe Biden, or at that point candidate Biden, released a proposed tax plan with a key focus on higher taxes for the wealthy and for U.S. corporations. So these proposals are not yet law. I think it will be helpful to be aware of them. The changes to the tax code have the potential to be quite significant, and the impact felt far through the U.S. economy, including the markets, and in many instances, possibly change our planning strategy on multiple fronts. So we're going to, in this workshop, look at some of these proposed changes. To begin with, President Biden proposed increasing corporate tax rates. So under the Tax Cuts and Jobs Act, which was the tax cut that was passed under the early days of the Trump administration, the U.S. corporate income tax rate was reduced from 35% down to 21%, which is where it sits today. Under the Biden tax plan, the corporate tax rate would increase from 21% to 28%. The proposal also calls for an increase in the marginal tax rate for top earners, which at this moment we're going to define as individuals, or the plan defined as individuals over $400,000. Biden's tax plan would raise the top marginal income tax bracket from 37% to 39.6%. Note that the Tax Cuts and Jobs Act, again, the tax cut passed under the Trump administration, that lowered the top marginal bracket from 39.6% to 37%, and that started on 1/1 of 2018. The proposal, Biden's proposal, was somewhat nonspecific, but here's a good visual of what a married filing jointly tax bracket might look like if President Biden has his way, or candidate Biden has his way. You'll see that even though the top marginal tax bracket would go from 37 to 39.6%, that doesn't tell the whole story, because right now incomes between $400,000 and $600,000 are taxed at 35%. Well, that swath of income earners would also get swept into 39.6%, and that is a pretty big tax increase, and I think we could all agree that individuals are earning over $400,000 are wealthy, affluent, high-income earners, but this is a pretty big increase in taxes, perhaps, compared to what has been in place the last couple of years. The proposal also calls for lifting the capital gains and dividend tax rates on filers with incomes above $1 million. So pay attention, because I switched from defining high income earners as those being over 400,000 to those with incomes over $1 million. So the plan would tax dividends and capital gains at the same income tax rate for individuals over $1 million. This would imply that large earners or large gains could see their rates increase dramatically. The way that it is now, and it's been like this my whole career and probably longer, I've been in a financial planner for 29 years now, is that you had two sets of numbers. You had your capital gains tax rate structure and your income tax rate structure. And capital gains were less than income tax rates for most people. And so what you would find is individuals with $1 million or more in income would, instead of having gains taxed at 20% and dividends taxed at 20%, it would go up to 39.6%, the top of the bracket. This would be notable. Unlike the previous slide, we've seen rates and brackets shift around. So that's kind of normal. You know, it goes up, it goes down, depending on who's president, what the economic circumstances are, and we could debate the merits of increasing and decreasing those rates. But this is an example, and there's a couple of others, that would be a substantial shift in policy on treating capital gains different than federal income tax. And it remains to be seen how this would affect the behavior of the wealthiest of Americans, because earning over $1 million is not your everyday kind of American you're going to meet on the street. But it remains to be seen how this would change their behavior, how that would impact, if at all, the economy and the markets. But it is something that would have quite an impact. Here's a visual of what capital gains tax rates could look like if the Biden proposal takes effect. Instead of 3 rates, there would be 4. And for individuals above that threshold, you're seeing 39.6%. That's double the tax. That is substantial, and that's likely to get people's attention and likely to change, as I said in the previous slide, change some behavior. How that would play out, we could debate, but again, pretty important consideration. Biden's tax plan also includes a cap on itemized deductions of 28% for those with earnings of more than $400,000. This means that for each dollar of itemized tax deductions, including charitable deductions, a taxpayer or a couple, maybe filing jointly, would only receive a maximum benefit of 0.28 cents. This 28% limit would hold true even if a filer is paying a higher marginal tax rate. So, for example, if this were enacted and you have $40,000 of deductions, then even in the highest brackets, you would only save 28%. So in this example, 28% of 40,000 is 11,200. So this is an example of sort of a double whammy for high income earners. Not only are their tax rates going up to a higher overall limit, not only is that limit kicking in at lower rates, but your ability to itemize deductions is going to get limited, creating more taxable income, and more of that income being at the higher brackets, driving more of a tax cost for the taxpayer. Hopefully I explained that well. The Biden tax plan would also phase out small business income tax deductions for taxable incomes over $400,000. This is very notable for small businesses. Now, this is a complicated piece of legislation, and the proposal didn't go into a lot of details, but I want to acknowledge it. I think we could probably agree that taxes for small businesses are already pretty darn complicating. This would not only be a complication, but it would take away some previously used deductions for small businesses. And $400,000 of taxable income for small business is not terribly rare. That would catch a lot of people and create an environment where they would want to plan around this and try and reduce taxable incomes because they would want to avoid taxes. The next thing I want to talk about is the step up in basis. And of what we talk about today, this is probably the area that most of you are the least familiar with. So I want to talk about step up basis. But in short, Biden's tax plan wants to put an end to the step up in basis. You may be wondering, what is step up in basis? Step up in basis is a tax law that applies to estate transfers, like when somebody passes away. When someone inherits investment assets, the IRS resets the asset's original cost basis to the value at the date of the inheritance. I think technically the date of death. And then the heir pays capital gain taxes on that basis. So let's use a little example. I buy a stock for $100, and I'm fortunate that stock at $100 grows to $1,000. Now, as the stock makes its way from $100 to $1,000, if I don't sell the stock, I have no tax liability currently. I accumulate what is called an unrealized capital gain. So there's a gain, but as long as I don't transact the stock, I don't pay any taxes. Now, if I sold the stock for $1,000, my basis is $100 in our example, I would pay capital gains tax on $900. Now, if I pass away and I haven't sold the stock, my heir would inherit the stock, and the basis would no longer be $100. It would go right to $1,000, meaning that the $900 of unrealized capital gain that I had built up during my lifetime, it goes away. It stays unrealized. My heir inherits the stock, and their basis is $1,000. Let's play this out a little further. My heir inherits it for $1,000 and then sells it for $1,100. They would pay taxes on the $100, the $100 above the $1,000 they inherited at. That $900 never got taxed. And so this would be a change that would be substantial because it would really change what has been tax policy forever and a day. So if Biden's tax proposal were to become law, heirs would not inherit a stepped up cost basis. And so if you think about this, and I'm going to assume that we haven't thought a lot about it, but if you think about it, that would create some liquidity issues. I use the example of a stock, $100 going to $1,000. Stocks, at least those traded on the exchanges, are pretty liquid. So if I inherit a stock, I might have taxes due. And I probably could sell that stock, some of it, to create some liquidity. But what if we're not talking about stocks or bonds and mutual funds that are pretty liquid? What if we talk about things that are relatively illiquid or maybe even very liquid? What about real estate, homes, farmland, land, artwork, other collectibles? What about a business? Those assets do not have a lot of liquidity, and heirs could end up being in a position where they inherit something and have to sell it, maybe even forced to sell it, because they have to realize the capital gains at that point. So this is not something you may have much exposure to, but this is a really, really important part of Biden's proposal. And unlike changing the tax rates and changing the tax brackets, this would be a fundamental shift in tax policy. One of Biden's more talked about tax plan changes is to significantly reduce estate tax exemptions. So right now, an individual that has an estate of $11.7 million or less, does not have to worry about federal estate taxes. And so for a couple, it's double that. So that's $23.4 million per couple. So for a long time now, families, individuals, have not had to do much planning to work around and try and avoid the federal estate taxes, which begins at like 45%, and that might go up. The Biden proposal calls for that $11.7 million to get reduced back to where it was years and years ago, $3.5 million. This means estates over that $3.5 million would be subject to estate tax. And so thinking about this, as I said a moment ago, a lot of families, a lot of individuals, they haven't had to think about this because the limits have been so generous. When you go down to $3.5 million per individual, that's still a fairly affluent American, but that will ensnare way more Americans than the current $11.7 million, meaning that a lot of planning will likely need to be done and thought given to how to avoid that estate tax bill that might come down the pike upon death. This is pretty substantial change because a lot of Americans that have over $3.5 million, they're going to seek legal counsel. They're going to come to their financial planners, talk to their accountants, and try and figure out a way to avoid what is a pretty onerous tax. 45% is a pretty steep estate tax, especially given that that money was already taxed when they earned it, theoretically, and they might have paid capital gains along the way. But driving it from 11.7 to 3.5, pretty big change, and that will get the attention of a lot of Americans if it passes, because they will want to avoid, and there are ways to avoid the estate tax. So as we begin to wrap up, I wanted to touch on two quick quotes that I think are appropriate and a little comical. Albert Einstein said, "The hardest thing to understand in the world is the income tax." And he said that a long time ago, and I believe that we would have 100% agreement that the tax code has only become much, much more complicated than it was in Albert Einstein's era. And Will Rogers said the difference between death and taxes is death doesn't get worse every time Congress meets. Given the changes with the potential changes with the step-up basis and the estate tax exclusion, I think Will Rogers' quote is very appropriate. I want to mention that in the last year, we've experienced so much change over the last 12 months. And what we've found is that a lot of financial advisors have not connected with their clients. And in many instances, people are unsure what to do with their money, what to do with their planning. They may not have a personal relationship with their advisor. So my ask of you is, if you know anybody that you care about and they would benefit from a fresh perspective, maybe a second opinion, please let us know. We would love an introduction. And given all the change that's happened, there might be people that would be open to a discussion with us. Of course, your health and well-being is our highest priority. Although the pandemic situation has improved, I don't think we're exactly out of the woods yet, although hopefully we are much closer. I appreciate the opportunity to help you with your financial needs, and we're looking to plan for your success together. I appreciate looking at the long list of people in attendance today. I really appreciate the business relationships I have that are personally very important to me. So thank you for listening today. I did want to mention two questions that I have gotten. One is, what about estate tax exemptions for estates in a living trust? I'm going to have to say, number one, we're not sure about that, but I do not believe that living trust assets would be outside of the estate. So let's say somebody has a living trust, and there are advantages to having a living trust, but I do not believe that one of those advantages will be that those assets avoid the federal estate tax calculation, meaning that those assets would be included in your estate. I would want to verify that, but I'm pretty confident that that is a good answer. And of course, this will depend a little bit on the language in the legislation when it is revealed. The other question I want to mention is that there's something that was passed in Donald Trump's tax cut a few years ago, and that was the SALT deduction. And even though I describe, and lots of people describe, President Trump's tax law as a cut, there was an instance where there was a little bit of a raise. What that tax law did was said that there was a cap of $10,000 that you could deduct for state and local taxes, including property taxes. So before that legislation, before Donald Trump's legislation, you had an unlimited deduction. So if you had $25,000 of property taxes that you paid to California, let's say, you could deduct that $25,000. Under that tax law, that was limited down to $10,000. So if you think about that, that affected high tax states like the one that I live in, Connecticut, where you have high property taxes and high state income taxes. And if you're in Florida, and I know many people that are listening today are in Florida, it's not as big of a deal, this limit. But if you have property in state and local taxes above $10,000, you are limited to $10,000. So this affected states like Connecticut, New York, New Jersey, Illinois, California probably are the big five. And if you think of those 5 states, they are reliably Democrat voting states. I think there is a chance, a very good chance, I'm speculating now, that President Biden eliminates the SALT deduction. I personally would be pleased with that because my taxes, state and local taxes, are above $10,000, so that was kind of a giveaway. I'm not sure that's good policy, but somebody did ask me about that. If I was a betting man, I would bet that the SALT restriction is lifted and we would go back to the prior policy where you could write off unlimited amounts of local taxes on your federal tax return. So if you have other questions, please email or contact me at the office. But again, thank you so much for listening. I appreciate everybody joining me today. Thank you and have a great day.